September 1929. The United States was not anxious. It was euphoric. Factories were operating at record capacity. Automobiles were reshaping mobility. Radios were entering millions of homes. Electricity was transforming industry. Newspapers spoke of prosperity without limit. The idea of recession felt obsolete. Irving Fisher, one of the most respected economists alive at the time, declared that stock prices had reached what looked like a permanently high plateau. He was not irrational. He was looking at data that appeared revolutionary. A new technological era had arrived. Sound familiar? Because today, in 2026, we are living through a moment that feels almost identical. Artificial intelligence promises exponential productivity. Mega-cap technology firms dominate market indices. Retail investors speculate through zero-day options. Central bankers assure us the system is stable. The language is different. The psychology is not. And history suggests that when the final phase begins, it moves faster than anyone expects. The clock may already be ticking. The 1920s were defined by transformation, mass electrification, automobiles, radio, consumer credit expansion. Each innovation reshaped society and each justified higher asset prices. RCA stock rose more than tenfold in just a few years. Investors didn't care about earnings. They cared about narrative. RCA was changing the world. Today, NVIDIA, Microsoft, and a small cluster of AI giants occupy the same psychological space. The argument sounds almost identical. This time is different. AI will replace labor. AI will eliminate inefficiency. AI will drive productivity so high that traditional valuation models no longer apply. In the 1920s, speculative enthusiasm spread through brokers' offices and word of mouth. Today it spreads through social media, online forums, and algorithmic trading platforms. Back then, investors used margin loans. Today, they use derivatives and embedded leverage. But the core belief remains: central banks will never allow markets to fall significantly. The Federal Reserve, we are told, has mastered the cycle. Soft landings are now engineered outcomes. Yet history warns us that the most dangerous bubbles form when institutions believe they have eliminated risk. Most people study crashes. Very few study what happens immediately before them. In the final months of 1929, the stock market didn't collapse. It accelerated. Between June and September, equities surged nearly 30%. It was vertical. This phenomenon is known as a melt-up, the final euphoric expansion of a bubble. A melt-up serves one purpose: to eliminate the last skeptic. It forces the bears to capitulate. It draws in sidelined capital. It convinces doubters that they were wrong. When the final buyer commits, there is no one left to buy. The market runs out of oxygen. Today, concentration risk is extreme. The S&P 500 appears strong, but remove 5 or 6 mega-cap tech firms, and the underlying breadth weakens dramatically. Small and mid-cap companies struggle with high borrowing costs. Consumer demand softens. Earnings growth outside AI leaders remains fragile. The index projects strength. The internals reveal stress. This divergence cannot persist indefinitely. In 1929, a handful of trusts masked deeper fragility. In 2026, mega-cap tech masks systemic pressure. The fireworks are distracting. The real warning does not come from equities, it comes from bonds, specifically the yield curve. Under normal conditions, long-term interest rates exceed short-term rates. Investors demand higher returns for longer commitments. But before every modern recession, the yield curve inverts. Short-term rates rise above long-term rates. This occurred before 1929, 2000, 2008, and again in this cycle. However, here is the critical nuance. Markets rarely collapse during inversion. They collapse when the curve steepens again. Why? Because steepening often signals emergency rate cuts. It means something is broken. In both 1929 and 2008, the yield curve began steepening shortly before severe financial stress emerged. The Federal Reserve cuts rates not because the economy is strong, but because liquidity is deteriorating today. The curve is steepening again. The narrative says inflation has been defeated, but liquidity metrics suggest tightening beneath the surface. When central banks pivot aggressively, it is often reactive, not proactive. And when the pivot comes too late, the system begins to fracture anyway. In 1929, leverage was obvious. Investors bought stocks with 90% borrowed money. A 10% decline erased their equity entirely. Today, leverage is more complex and less visible. Hedge funds use basis trades involving treasury futures and repurchase agreements. Retail traders use options that offer enormous exposure with minimal capital. Structured products embed leverage inside layered financing arrangements. Shadow leverage hides in derivatives, private credit, and non-bank balance sheets. This makes the system appear stable until volatility returns. When asset prices decline, margin calls are triggered. Investors do not sell what they want to sell, they sell what they can sell. Liquidity vanishes quickly. Correlations approach. When in October 1929, shares did not simply fall, they evaporated. There were moments when bids disappeared entirely. Modern markets are faster. Algorithms accelerate feedback loops. And when leverage unwinds, cascades move at digital speed. If margin debt was the fuse in 1929, commercial real estate may be the fuse today. Unlike residential mortgages, commercial loans are typically short-term and interest-only. They require refinancing every few years. Between 2020 and 2021, trillions of dollars in commercial loans were issued at historically low interest rates. Now they must be refinanced at rates 2 or 3 times higher. At the same time, office occupancy has permanently declined. Remote work altered demand patterns. Vacancy rates in major cities remain elevated. Lower rental income, higher interest costs, rising insurance and maintenance expenses. The math is unforgiving. A significant portion of office loans now exceed property values. Owners are underwater. And when owners default, lenders absorb the loss. Large national banks reduced exposure early. Regional banks did not. Smaller and mid-sized institutions hold the majority of commercial real estate loans. For many, CRE represents nearly half of their lending portfolio. If defaults accelerate, capital buffers evaporate quickly. And unlike bond liquidity programs, the Federal Reserve cannot manufacture tenants. Beyond traditional banks lies a rapidly expanding sector, private credit. Over the past decade, private credit assets grew into the trillions. These firms lend directly to companies outside traditional banking oversight. They thrived in a world of low rates and minimal defaults. But private credit lacks daily market pricing. Valuations are often internally determined. If a borrower struggles, managers may extend loans rather than recognize impairment. Interests may be paid in kind, meaning it accrues rather than being paid in cash. On paper, returns appear smooth. In reality, risk compounds silently. The trigger event may not be a stock crash. It may be a redemption freeze. If a major private credit fund suspends withdrawals, investors quickly realize liquidity was illusory. When illiquid assets cannot be sold, liquid ones must be stocks and bonds become funding sources. That is how contagion spreads. The greatest lesson of 1929 was not the crash, it was the policy failure that followed. The money supply contracted sharply in the early 1930s. Banks failed, credit evaporated. Deflation deepened the depression. Modern policymakers have studied this period extensively. They have pledged never to allow deflationary collapse again, which means the next crisis may not resemble the 1930s, it may resemble something else. If faced with a choice between allowing systemic defaults or monetizing liabilities, central banks are likely to choose liquidity expansion. Yield curve control could cap government borrowing costs. Debt could be absorbed into central bank balance sheets. Deposits could be guaranteed universally. Liquidity would flood the system, and in that environment, nominal asset prices may rise not because growth improves, but because currency and purchasing power declines. This dynamic is known as a crack-up boom. Investors shift from seeking returns to escaping cash. The psychology transforms rapidly. In a crack-up phase, asset prices soar in nominal terms, but real purchasing power deteriorates. Cash savings lose value. Fixed income assets lag inflation. The middle class absorbs the adjustment. Asset holders endure. This widens inequality. Trust in institutions erodes. Political tension intensifies. Historically, severe financial dislocations often precede broader social upheaval. Every 80 years or so, institutional legitimacy faces stress. When the public perceives that monetary systems favor asset owners over wage earners, resentment builds. Financial crises do not remain confined to financial markets. They spill into politics, policy, and social stability. The 90-day concept is not a prediction of exact timing. It represents a phase shift. The transition from euphoria to complacency. From complacency to denial. From denial to panic. Today, volatility remains subdued. Confidence remains elevated. But beneath the surface, divergence grows. Yield curves steepen. Regional banks weaken. Commercial refinancing walls approach. Private credit valuations strain. The pattern is visible. History does not repeat precisely, but leverage and liquidity cycles rhyme. The most dangerous moment is not the crash. It is the calm before it. Because once panic begins, liquidity disappears, and preparation becomes impossible. The blueprint exists. The question is not whether history will rhyme. The question is whether participants recognize the rhyme in time.